Hey everyone, I hope everyone is doing well and had a good day today. In this video, I'll do a brief review of the Emini 5-minute chart for Friday, May 23rd, 2025, and I want to go through this marked up chart and just talk about what I think were some of the most important points to cover. So, as we went into the day, if we looked at the higher time frames, there were two big legs down for the bears. The first leg we could see in the afternoon. There was a midday reversal on Wednesday, and then Thursday was spent going sideways to up, correcting the sell-off. But I thought the bears didn't get their second leg yet, and most of the time a bull channel is a bear flag. It's going to break out to the downside and create a trading range or trend resumption for the bears. And that's what we had on the gap down going into today. So we gapped down and the bears have their second leg down. And I'm just going to touch on this quickly. I always think it's really interesting how there's always a news event that you can blame or credit for market behavior, market movements. But to me, it's really all baked into the price action. And if you're a technical trader, you're trading price action, one of the beliefs that I don't want to say you should have, but I know my mentors, Brooks, Ali Moin-Afshari, Brad Wolf, I know those guys fully believe that all the information they need is on the chart in front of them. They don't need to look at the news to basically for indicators or to know why the market is doing what it's doing. Basically, the point is everything's on the chart. And what I think is fascinating is there always seems to be a news event, whether it's political or there's a natural disaster, or if it's a stock, maybe earnings report, whatever it is, there always seems to be something that the news can write a story about and blame if it's bearish or credit if it's bullish. But we didn't even have to know. And the whole reason I'm saying this for those of you who don't know is that President Trump was tweeting this morning at like 5 a.m. or maybe 5, 6, 7 a.m. And we had that big sell-off before the market opened in the Globex session around 7 a.m. Eastern time. And what's so fascinating is that no one could have predicted that Trump is going to tweet or what he's going to tweet about or what the reaction in the market would be. But we can all see the price action from the past couple of days, and we all saw the sell-off on Wednesday, the bear flag or leg in a trading range on Thursday, and then we had that big gap down in the morning today. And I didn't need to look at the news to understand any of that. So I think it's just really fascinating. It's one of those things that Al talks about definitely in the books. He says, the news is for entertainment, but the people who get interviewed on the news or who write reports, whatever it is, they're selling advertisements and they're not traders. And if they were traders, they would be trading. And I don't want to get too off course with that, but basically the whole point with that is one of the beliefs for good price action traders is that all of the information you need is baked into the price action on the chart in front of you. So you need one chart. It's good to have an idea of what's happening on the higher time frames, but you don't need news. You don't need 5 different charts open at once. You just have to understand what's happening on the chart in front of you. So for today, going into the day, we had that gap down, and it's, the gap down was, if I remember correctly, over 100% of the average daily range for the past several days. And because of that, I thought the downside would be limited. The gap down is the Globex session that includes the extended trading hours. So if the market rallies and starts to go in the direction to close the gap, then the daily range will not grow and it will not shrink. It will just stay as it is. So I thought the downside would be limited for today, but we might do something like this and maybe have a channel or a trading range that is more bullish to the upside because of profit taking from the bears. But overall, was today a strong bull trend day? No, it wasn't. And let's start talking about the chart. So the main thing I want to talk about is this channel. I have a channel line drawn from connecting this high to this high, and I like to use a best fit line. So there's an overshoot here, an overshoot here. I could have drawn the channel line from this high to this high somewhere up here, but then we'd have lots of undershoots, and I like to look at lines that the market pays a lot of attention to. So best fit lines that get tested many times. So lots of little tests in here. We even tested it a lot over here. So taking that channel line, I drew a parallel and dropped it here. Again, I like overshoots, so putting it on this low so that bar 1 is an overshoot, overshoot here, slight overshoot there. And that's just the way I like to draw my trend line and channel line. So for breakouts today, if we look at the bars that I have highlighted, there's kind of a color code, and obviously the green boxes show bull breakouts, the red boxes show bear breakouts, and the orange or yellow boxes show what are either late legs and or possible climaxes and breakouts that might be better to fade, and I want to briefly touch on each one. And at the end, if I remember, there's something that all of these breakouts that I have highlighted have in common, and I'm hoping when I get over here I'll touch on it, because you might ask, well, why isn't this one highlighted in green? It's following a yellow box, and a lot of the yellow boxes are followed by a red box or a green box. So why not this one? And I'll touch on that. So for the first one of the day, we have a bull breakout bar, and look at the overlap with the prior bar. Maybe 25% of the bar is overlapping with the prior bar, but the majority of the bar broke out above the prior bar and it closed far above the prior bar. So traders who sold above this bar, well, they did something reasonable. The market is in a tight trading range, lower highs, higher lows, or at the apex of a triangle, and traders who bet on the breakout failing are doing something reasonable. They set a limit order to sell above this bar, they get trapped on the bull breakout, and they look to exit and buy back shorts on the retest, which is what contributes to the fuel that creates a second leg up. So bull breakout, pull back, second leg. Now this was all tight enough that the first reversal down might be minor. So we had this decent looking bear trend bar, but look at the overlap with the prior bar. It's overlapping the prior bar by 100%. It's an inside bar. So even though the bar itself is strong, it's not breaking out of anything. It's an IOI pattern, breakout mode, but in a largely sideways market. Lots of overlap here, very tight trading range, and overlap here. So probably buyers below. This gap is still open. We test it. We get a rally for a couple of pushes up. So this is basically a spike and channel bull trend. Now here we have what might be the third push up. We have a breakout, a pullback, a second leg, pullback, a third, maybe a third leg, pullback, a fourth push, and even here another pause, a fourth or fifth push here. So these are not ideal for buying this bull trend bar. is in a bad location. It's at the top of a channel where there's clearly resistance. The market is having a hard time breaking above this level. And look at the overlap with the prior bar. Probably 90% or more of the bar is overlapping. It's not really breaking out of anything. So trend bar with bad context and bad follow through. So bad high 1, bad context, probably sellers above. And then same here. So doji, and this one's actually an outside bar, which is an indication of trading range behavior at the top of a channel, 3 legs up. If it's an expanding triangle, there are probably buyers below and sellers above. So we found sellers above, and here the buyers below got trapped. This bear breakout is breaking far below the low of the prior bars, only maybe 25% of the bar overlapping the prior bar, and a decent follow-through bar. Small, but another bear bar closing near its low. So, second leg down, likely trap traders at the low of this doji bull bar, probably looking to sell. If you bought here, you got trapped, you're looking to exit, and if a bull is looking to sell, and the bears are always selling, then we have a breakout pullback sell for the bears, and a breakout pullback or a breakout test of this breakout point where the bulls who bought with limit orders got trapped. Bulls are looking to sell out of longs and look to buy lower, so we get a second leg down. 1, pullback, 2, pullback, 3. So this is leg 3 for the bears. What's the problem with down here? Well, it's a micro double bottom, which is also nested. We went down and up, and on these 2 bars, down, up, and also I counted 3 legs, 1, 2, 3, but also the trend line. So again, drawing the channel line and creating a parallel with an overshoot on bar 1 and a perfect test here. That also creates a support level there. So a couple of reasons to not look to sell here. And if it's bad for selling, it's good for buying. Everything has an opposite. So here we get a strong bull breakout bar, a pause, and then a strong follow-through bar. So pretty strong bull breakout. Maybe the first breakout bar overlapping half of the prior bar, but a pause and another strong follow-through bar, good for the bulls. What's the problem? It might be a late leg here, maybe 1, 2, or 2, 3. So it might be leg 3. You expect a deeper pullback, but strong enough rally for the second leg. So when the bulls get bad follow-through at the top of the channel, the market starts to pull back deeper, and bulls look to buy a deeper pullback, and bears see that they could have made money selling back here. You can probably make money selling here. So bear breakout and follow through, breakout point test, and it's very similar to what happened over here. Bear breakout, pullback, second leg down, pullback, attempt at a third leg, but very similar to here. So an attempt at a third leg down, but on support in a bull channel, bull breakout, close above the prior bar, maybe half the bar overlapping, so traders buy a pullback. Not much sense of urgency, not a good follow-through bar, but buyers below this bar, and the bulls get their second leg, and then a strong bull breakout here as well. So this breakout bar, maybe 20% of the bar overlapping the prior bar. That's good. Follow-through bar, bull close, and then a stronger follow-through bar, so another good bull breakout. Pullback likely, but second leg likely. Why pullback likely? Because a little bit of a climactic bar. It's one of the biggest bars in the rally. It's testing the top of the channel. It's the third major test. If we looked at a higher time frame, it's leg 3. But look at the selling pressure through here, and we have an open gap here, open gap here. So the bulls have a couple of open gaps. We cross the moving average. We're breaking far above all the bars to the left. This breakout should get a second leg. We come back and retest the pause bar, and it looks like we may have tested, not sure if we got there, but close to this bar, maybe not quite. But that was a breakout point. This is a breakout point. Market tested it, could not close below. The bulls got their second and third leg up. Now 3 legs up, and it's a nested leg 3. So 1, 2, and then 3, and 1, 2, 3. So 3 legs at resistance. Not good for buying, probably better to look to sell. And then the bears get this outside bar and follow through. Outside bars are very context dependent. Like in here, did we get an outside bar? Yeah, this outside bar, so IOI, but when the context is a tight trading range and you get an outside bar or an IOI breakout mode pattern, it's less meaningful. You kind of already know that the market's in breakout mode. But here, 3 pushes up in a rally that's lasted the majority of the day. But again, is today a strong bull trend day? Not really. It probably is a type of trading range day. If we draw a horizontal line or a box, we could contain a lot of the bars here in the first half of the day in a trading range. So we had a lower trading range, bull breakout, and then an upper trading range. So most of the day was spent going sideways. And with that said, we had this outside bar trapping traders above and then breaking out below and then getting followed through. Follow through bar, not all that strong, but distance is pretty good. So breakout below, the prior bar's low, and then the distance follow through was good. Second leg down likely. We pulled back for a couple of legs, and then the bears got their second leg. What's the problem with this one? We have leg 1, pull back, leg 2, leg 3, a breakout attempt of a double bottom, which is functionally a wedge. It's a third attempt. 1, 2, 3. So probably better to look to buy here. The bears, think about this bar. This bar traps traders as well, this reversal bar. On a smaller time frame, the market sold off and then rallied, and that rally creates support, and probably the midpoint of this tail on this bar, the buy zone of the bar, is support. So you could buy here or lower, and that's what traders did. We tested the buy zone of the bar, and we bounced. We bounced. Tried again, and we bounced. So why do I not have this one highlighted in green? It's because of the overlap I've been talking about with pretty much all the other breakouts. Look at the other bull breakout bars. Not a lot of overlap with the prior bar. Maybe about half the bar overlapping, but good follow through. Not much overlap. Not a lot of overlap at all. This one, probably 80% of the bar is overlapping the prior bar, and the follow through was weak. Smaller bull bar, tail, and the context, the big picture. If this is a bull channel, we expect the bear breakout and the eventual transition into a trading range. So the bulls are exhausted. Those, every time we go to a new high, there's profit taking. New high, profit taking. New high, pause. New high, profit taking. Another new high, profit taking. So here, we might be transitioning into a trading range, and if that's the case, where is the start of the trading range? It could be all the way back down at bar 1. It doesn't mean we'll necessarily get there today, but the fact is, if this is a channel, the bulls are probably not going to suddenly get a lot of energy and be excited to buy at a new high. They're going to keep doing what they have been doing, which is taking profits at a new high. And eventually the trend weakens and transitions into a trading range. So kind of a big down, big up situation here. Bears, they might see this as a tighter bull channel, trendline break, retest, and maybe a double top, lower high, major trend reversal. But trading range, more likely. And then this bear breakout, not maybe half the bar overlapping the prior bar, but a couple follow through bars. Distance was good. And this was actually a spike in channel on a smaller time frame. So pullback likely, it's leg 3, 1, 2, 3, nested, 1, pullback, 2, pullback, 3. But not a good buy signal. Context, probably trap traders below this bull bar, resistance here. So bear breakout, pullback, testing a breakout point, second leg down. And this looks a little climactic for the bears. Another possible late leg in a channel. We're testing support from earlier in the day. We're also getting late in the day. The downside here might be limited. But at the end of the day, you have institutions who, there are risk managers walking around making sure everybody's flat, nobody's in a position, we're taking profits, closing up for the day. And the traders will take profits if we're buying all the way up. At the end of the day, you look to take profits. It's possible in the final few bars you get a big sell-off, especially because it's a channel, not a very strong channel, and the channel is expected to transition into a trading range, and we could test all the way down here maybe next week. So that's it for today's review. And before I wrap it up, I just want to talk briefly about systems. The importance, just a reminder that it's really important to go into the trading day with a plan and make sure your plan is repeatable. It's something that you can apply every day, no matter what the market gives you. Make sure it's something reasonable and logical. And from a very high level perspective, it should be something as simple as trade breakouts and second legs. I mean, that's the best advice anyone could give anyone for price action trading, I think. Ali has done lots of research, and he's found that there's no better setup. There's nothing better than understanding breakouts and second legs. And because price action is fractal, there's no shortage of setups throughout a day, and you can design your system so that it can participate no matter what the market cycle is, whether you're buying or selling, and whether it's a strong breakout or a trading range, whatever it is. It's really important to start with one idea and just keep applying that same idea over and over. I just recently heard Jordan Peterson say, "It's a very good idea to move forward with a bad plan." Because if you implement a plan that isn't perfect, you'll learn exactly why it isn't perfect. And I think that's perfect for understanding trading systems. The most important thing I could say is, for anybody listening who's struggling with developing a system, if you're anything like me, you might be waiting for the perfect idea to come along, or studying and trying to understand things better. But the best advice I could give is create a bad system. Just build a system, meaning a repeatable process you can follow every day, even if you only have 1 or 2 trades a day, and stick to it for a month or 2 months, and it will reveal to you where you need to make improvements. But until you can trust yourself, that you can trust your actions, you can trust your discipline to act on the same process over and over, not deviate from it, not act on impulse or intuition or discretion or whatever. The point is, get to the point where you're only taking type 1 and type 2 trades, meaning a type 1 trade, you follow the process, you got a good outcome. Type 2, you follow the process, you got a bad outcome, you lose the trade. Stay away from type 3 and type 4 trades. Type 3, you do not follow a process, you have a bad outcome. And type 4, you do not follow a process, and you have a good outcome. Because type 4 is the worst kind of trade. It reinforces bad behavior. You get rewarded for doing an unplanned or wrong thing. So the main goal, I think the first goal to strive for, is become a trader who only takes type 1 and type 2 trades. And if you're not sure if you're taking type 1, 2, 3, or 4 trades, then you haven't defined your system clearly enough to yourself. So keep working at that. And when you get to the point where you're only taking type 1 and type 2 trades, that's great, because from there you have the discipline, you can trust yourself, and you can move forward in refining what you're doing and improving what you're doing and expanding what you're doing into other areas. So I hope that's all helpful. And that's going to be it for today's trade review. So thanks everybody for watching, and I hope everyone has a great weekend.